Welcome back. Well, we're going to take a step aside from the macroeconomic analysis and interest rates, Federal Reserve meetings, and discuss one of the most commonly used technical indicators, which are moving averages. Now, there are many different strategies that we can employ, whether it's a moving average crossover, when one crosses over another, if the stock market crosses above or below a moving average. We want to take a look at the data. What does the data actually suggest? What's the best way to use these moving averages? Right here we have the black dotted line is the S&P 500. This is going back to July of 2022. The red line is the 10 simple moving average. That's just the past 10 days divided by 10. The purple line is a 20 SMA. The yellow is a 50 simple moving average. The blue line is a 90, and the green line is a 200. Now, if we open up the charts and we say, okay, well, the market right now, the S&P 500 is above the 10 SMA. What does that mean? That means that over the past 90 days, over the previous 90 days, on average, the S&P 500 has returned around a 4.6% return. Over the past 90 days, if it's above the 20 SMA, it means the market has gone up around 5.1%. 50 SMA, 5.7%. 90 SMA 6.1, and above the 200. If the market right now is above the 200 SMA, it means on average over the past 9 years, our data goes back to around 2014, it means the market has gone up around 6.1%. So clearly, if we open up the charts and we see the stock market is above these simple moving averages, especially the longer term ones, it means it has been performing quite well. The 6% level is pretty important because we know on average the S&P 500 over the past several decades averages around 10-12% a year. If we can make 6% a quarter, 6% every 90 days, that's certainly we would outperform the averages. Well, what if the market is below the 20 simple or the 10 simple moving average? Over the past 90 days, it means the stock market has gone up only 1%, underperforming its historical averages. If it's below the 20 SMA, it means it's been down actually 0.2%. Below the 50, down 2%. Below the 90, down 4.6%. And if the market right now is below the 200 simple moving average, it means on average it has been down over the past 90 days around 6.7%. If we see the market below the moving averages, it tells us something has not been good. Now, maybe it's a good time to buy. Maybe the market's bottomed out. We would employ other, levels of technical analysis and fundamental analysis to look for confirmation. But these moving averages tell us if the market's below it, something has not been right. Well, that's, very good and well, but how can we use this moving forward? Well, if we look at the following chart, we say, okay, if the stock market, the S&P 500 is above the 10 SMA, over the past 9 years, the data suggests that over the next 90 days, on average, we expect the S&P 500 to go up around 2.7% over the next 90 days. If it's above the 20 simple moving average, 2.6%. Above the 50, around 2.6% as well. A little bit less. If the stock market is above the 90 SMA, the next 90 days, on average, we expect a 2.7% return. And if we're above the 200 SMA, 2.9%. So, we're in a pretty close range here. I know the chart, shows a big divergence, but we're taking lows between 2.6 and 2.9%. We want to see the stock market above the moving averages by far. Because that does suggest that the market will perform better. Conversely, if we open up the charts and we say, okay, well, where are we right now? The S&P 500 is below the moving averages. The data suggests this is how the market may perform moving forward. Below the 10 SMA, around 4.3. Around below the 20 SMA, 4.5. Below the 50 SMA, around 4.8. And if it's below the 90 simple moving average, 4.9%. Below the 200, 4.4. So the best results we see here, if the S&P 500 is below the 90 simple moving average, over the next 90 days, we expect around a 4.9% return. Well, let's take a look back. That's if it's below the 90 average, the 90 simple moving average. What if it's above the 90? 2.7. Below the 90? 4.9. The data suggests that if the stock market is below the 90 simple moving average, we tend to see the next 90 days superior performance. That does not mean that we can buy it every time it goes below the 90. We want to look for other areas of confirmations, to be sure. But over the long term, stock markets tend to go up. If we see the stock market below the 90, then that tells us, okay, I think we can expect, superior returns moving forward. But interestingly enough, if it's below the 200, not so much. Point being, and this is only what the data suggests, that if the stock market is below the 90 but above the 200, well, maybe perhaps, we could see superior returns. Well, where are we now? The black line is the S&P 500. Again, the red line is a 10 simple moving average. The purple line is a 20. The 50 is yellow. The 90 is blue, and the 200 is green. Well, right now the S&P closed around 40.91. The blue line, which is a 90, is 40.27. And the green line, the 200, is at 39.69. So if we were, for example, and this is not a trade recommendation, but it's one idea that we could logically come to. If we see the markets below the 90 but above the 200, in this little space here between the blue and the green lines, maybe that would be, at least this is what the numbers show, maybe that would be an opportune time for us to get involved. And there's many other ways that we could consider these numbers. We could say, well, what if all the moving averages are in order, meaning that the 10 is above the 20 is above the 50, so on and so forth. We're going to continue to expand the study because I think it really gives us a very interesting look at the markets, and maybe whether we have a trend trading type of philosophy or buy on the dip value philosophy as far as trading. Maybe we could customize this to our own needs. And I think that's an important thing as well. We should try to understand, identify what kind of trading we're most comfortable with. Buying new highs or buying after it goes down, and then use the tools, accordingly. We hope this has been helpful. We look forward to seeing you back soon.